The financial planning industry has spent 50 years selling you a story about retirement, and that story has one foundational assumption at its core. The assumption is this: the moment your employment income stops, a slow and irreversible wealth erosion begins. You will spend down. You will draw down. You will watch the number decline until either the money runs out or you do. That is the architecture of every retirement calculator you have ever used, every projection your advisor has ever shown you, and every anxiety that has kept you working one more year past the point where the math actually required it. Here is what the institutional data says about that assumption. It is wrong. Not partially wrong. Not wrong for wealthy people only. Structurally, documentably, and measurably wrong for any American household that crossed 4 specific financial thresholds before the retirement entry date. The Bureau of Labor Statistics Consumer Expenditure Survey, using data collected across every income quintile of the American population, documents that average household spending drops from $72,967 annually at peak earning age to $57,818 by ages 65 to 74. That is a 20.8% reduction in baseline expenditure that occurs automatically, without lifestyle sacrifice, driven entirely by the natural elimination of work-related costs. Before a single investment decision is made. Before Social Security is claimed. Before Medicare activates. The expense crater opens by itself. And it is only the first of 8 simultaneous financial forces that converge at retirement entry for the adequately prepared household. The mechanisms and data presented throughout this analysis illustrate documented population-level financial patterns. Individual outcomes depend on specific tax situations, health status, portfolio composition, and geographic variables. All retirement income and tax strategies should be modeled with a licensed fiduciary advisor and qualified tax professional before implementation. Place these two realities side by side. On the left, what the standard retirement calculator shows, a declining balance curve bending toward zero across a 20-year horizon. On the right, what the clinical data from 8 simultaneous institutional sources actually documents, 8 force vectors converging upward on net worth simultaneously. The gap between those two pictures is not a rounding error. It is the difference between a retirement built on fear and a retirement built on evidence. Now examine the first 2 forces in detail, because they arrive together and they interact. The IRS Statistics of Income Division confirms that the average effective federal income tax rate for taxpayers aged 65 and older earning between $40,000 and $75,000 is approximately 8.3%. Compare that directly with the 17.4% effective rate paid by working-age taxpayers in equivalent gross income brackets. That is not a modest adjustment. That is a near halving of the tax burden driven by 4 simultaneous mechanisms activating at once. The enhanced standard deduction for taxpayers over 65 reaches $15,700 for single filers and $30,800 for married couples filing jointly in 2024, $3,000 higher per qualifying senior than the standard deduction available to working-age filers. Qualified dividends and long-term capital gains face a 0% federal rate for married filers with taxable income below $94,050. And the Roth conversion laddering window, the low-income years between retirement and required minimum distributions, creates a structural opportunity to reposition tax-deferred assets at the lowest effective rates of an entire financial lifetime. Researchers call this convergence the retirement tax valley. Now layer the 5-category BLS expenditure collapse directly on top of it. Transportation spending drops 34%. Apparel and services fall 28%. Food away from home decreases 21%. Personal insurance and pension contributions, the payroll taxes and benefit premiums that consumed a significant share of every working paycheck, collapse 61%. Childcare and education expenses fall 73%. The net monthly financial improvement produced by these 2 forces alone, before any investment return is considered, rivals a meaningful salary increase for the median American household. Now examine what happens to the portfolio during this period, because this is where the retirement calculator's foundational assumption fails most completely. Research from the Center for Retirement Research at Boston College, analyzing 30-year Monte Carlo simulations at withdrawal rates between 3.5 and 4%, documents that 68% of simulation outcomes produce a terminal portfolio value that exceeds the starting balance at retirement entry. Read those numbers carefully. The majority of statistically modeled outcomes show the retirement portfolio ending larger than it began, even while supporting consistent withdrawals across 3 decades. The mathematical mechanism driving this outcome is the compounding multiplier effect of positive early returns acting on the full portfolio balance before withdrawals have meaningfully reduced the principal. A strong early sequence creates a permanently elevated base that subsequent withdrawals cannot fully erode. Layer the Society of Actuaries 2023 mortality research on top of this mechanism. A 65-year-old American couple carries a 50% probability that at least one spouse survives to age 90. Financial planning models that assume a 20-year retirement horizon, to age 85, systematically underestimate the compounding runway that actuarial reality provides. A portfolio earning 6% annually across a 25-year horizon does not produce 25% more terminal wealth than a 20-year horizon. It produces approximately 34% more, because the compounding of additional years operates on an already substantial base. Longevity is not only a risk to be managed. For the adequately prepared household, it is a mathematical dividend that arrives from surviving longer than the model assumed. Consider what Stanford University's Center on Longevity identified after analyzing 292 distinct Social Security claiming strategies across the American population. 73% of Americans claim Social Security suboptimally, leaving a cumulative lifetime present value of $111,000 per household uncollected through suboptimal claiming decisions alone. Notice this figure on screen. $111,000. Not from a bad investment. Not from a market crash. From a paperwork decision made without adequate research at a government office counter. The optimal strategy for a married couple where both spouses are in average health operates through a specific sequencing mechanism. The lower-earning spouse claims early, activating the spousal benefit structure and beginning the household income stream. The higher-earning spouse delays to age 70, capturing the 77% benefit increase that accumulates at approximately 6.5 to 8% per year of delay beyond full retirement age. The higher earner's delay also maximizes the survivor benefit, the permanent, inflation-adjusted income floor that protects the surviving spouse for the remainder of their lifetime. The Social Security claiming decision is made once. It is not revisited. The $111,000 in lifetime present value that 73% of Americans leave uncollected is not recoverable after the claiming date. The window to optimize this decision closes permanently at the moment you file. The fifth force arrives on the day you turn 65, and it produces an effect that no competing financial analysis has ever quantified correctly. The Centers for Medicare and Medicaid Services actuarial analysis confirms that Medicare combined with a standard Medigap Plan G supplement delivers an actuarial value, the percentage of healthcare costs covered, averaging 88%. The average total annual premium for this combination in 2024 runs approximately $3,200 to $4,800 depending on state and age. Now place this container directly beside the cost of maintaining equivalent coverage through the ACA marketplace for a 63-year-old couple, $23,400 to $28,000 annually before cost sharing. The gap between these two containers runs $18,000 to $22,000 per year. Now translate that gap into portfolio language using a 4% withdrawal rate. An $18,000 to $22,000 annual cost reduction requires $450,000 to $550,000 less in portfolio capital to sustain. The Medicare transition does not merely reduce your healthcare costs. It produces the functional equivalent of a $450,000 to $550,000 addition to your retirement portfolio balance appearing automatically on the day you turn 65. The 2.5 years between age 62 and age 65, the bridge period when private insurance costs are highest and Medicare has not yet activated, represent the most expensive healthcare window in the retirement timeline. The mitigation tool is health savings account pre-funding during working years, capturing the triple tax advantage before the Medicare enrollment date eliminates HSA contribution eligibility. The mechanisms and data presented here illustrate documented population-level patterns. Individual outcomes depend on specific health status and plan availability. All healthcare coverage decisions should be evaluated with a licensed benefits specialist. The Federal Reserve Survey of Consumer Finances documents that the median home equity for American homeowners aged 65 to 74 is $250,000, with the top quartile exceeding $450,000. National Association of Realtors data establishes that retirees who downsize hold their primary residence for an average of 28 years before the sale. Follow that 28-year hold period through the inflation-adjusted appreciation data. The median American home appreciated 287% in real terms since 1990 across the median hold period. Now apply IRS Section 121 to the proceeds. The capital gains exclusion of $250,000 per individual, $500,000 for married filers, applies to the sale of a primary residence owned and occupied for 2 of the preceding 5 years. This is the largest tax shelter available to the American middle class, and it requires zero advance planning to access beyond the 2-year occupancy requirement you have almost certainly already satisfied. The net tax-free liquidity event from a downsizing sale averages $180,000 to $320,000 for the retirees in this profile. Follow this curve forward, the released equity reinvested at 7% for 15 years. The Section 121 capital gains exclusion opportunity has a structural requirement. 2 years of primary residence out of the preceding 5 must be satisfied before the closing date. This is not a benefit you can establish retroactively after the sale documents are signed. The Federal Reserve and Cerulli Associates project that $84.4 trillion will transfer between generations in the United States between 2021 and 2045. The largest intergenerational wealth transfer in documented human history. The timing alignment embedded in this projection carries specific relevance for retirement planning. The peak inheritance receipt age in the United States is 61 years old, positioning this capital event precisely at retirement entry for the majority of recipients. The Federal Reserve documents median inheritance received by Americans in their 60s at approximately $69,000, with the top quartile receiving $220,000 or more. Map the compounding runway forward. $69,000 received at age 62, invested at 7%, compounds to approximately $267,000 by age 82. This is not a variable to count on as a planning input. It is a variable to understand actuarially so it can be incorporated into stress testing scenarios rather than arriving as an unexpected windfall that is handled reactively rather than strategically. AARP and the RAND Corporation document that approximately 31% of retirees return to some form of paid work within 5 years of initial retirement. The research distinguishes clearly between necessity-driven return, approximately 8% of retirees, and purpose-driven return, approximately 23%. The purpose-driven returnees are not failing at retirement. They are executing what self-determination theory identifies as intrinsically motivated engagement, work chosen for its own sake, structured on autonomous terms, producing income that arrives as surplus rather than survival. The average annual income from Encore career work among college-educated retirees runs $24,000 to $36,000. Because baseline expenses are already covered by Social Security and portfolio distributions at this stage, 100% of Encore career income flows directly to net worth accumulation. $30,000 per year of surplus income invested at 7% for 10 years produces $414,000 in additional terminal wealth. That number belongs in every retirement projection that accounts for the behavioral reality of what adequately prepared retirees actually do with their time and energy in the first decade of retirement. DALBAR's quantitative analysis of investor behavior, tracking 30 years of documented investor returns, establishes the most important and most underutilized finding in all of retirement finance. The average equity mutual fund investor earned 6.81% annually over the past 30 years. The S&P 500 returned 10.19% over the identical period. The gap, 3.38% annually, was not produced by fees, by asset allocation errors, or by bad luck. It was produced entirely by behavior. Buying when confidence was high. Selling when fear arrived. Re-entering when the headlines turned positive. A 3.38% annual behavioral gap compounded across 30 years does not produce a modest performance shortfall. It produces a terminal portfolio value that is a fraction of what disciplined behavior would have generated. Vanguard's Advisors Alpha Research quantifies the behavioral coaching premium at approximately 1.5% per year in additional portfolio returns, not from superior stock selection, but from preventing the 4 behavioral failures that erode the disciplined investor's structural advantage. The 4 behavioral disciplines that close this gap are specific and executable. First, a written withdrawal plan trusted before markets tested, not constructed during a downturn. Second, a cash buffer covering 2 to 3 years of living expenses, eliminating the forced selling mechanism entirely. Third, a quarterly monitoring maximum frequency, not daily, not weekly, quarterly. Fourth, a written investment policy statement that defines the decision rules before emotional conditions arise that would compromise them. The 8 forces described in this analysis are not strategies you execute through superior intelligence or market timing. They are structural realities that activate automatically for any American household that crossed 4 specific thresholds before the retirement entry date. Track these thresholds as a sequential pipeline. Threshold 1, a savings rate sufficient to accumulate 25 times annual expenses at retirement, the capital base required for the 4% rule to function. Threshold 2, 0 high-interest consumer debt at retirement entry, eliminating the only mechanism that can convert the expense crater into a cash flow deficit. Threshold 3, a housing decision optimized before the transition, either owned outright, providing cost certainty and Section 121 eligibility, or structured as strategic rental with the capital equivalent deployed. Threshold 4, a Social Security claiming strategy modeled before the claiming decision, the only window in which the $111,000 optimization premium is still recoverable. These thresholds are crossed during working years. Every year of inadequate savings rate, every year of high-interest debt carried, every year of deferred housing optimization, and every year without a Social Security claiming strategy represents a permanent reduction in the probability that retirement becomes a wealth acceleration phase. The forces are automatic. The thresholds are not. The goal was never to get rich in retirement through investment genius. The goal was to cross 4 thresholds during the working years and then allow 8 simultaneous structural forces to compound in your favor while you decide what to do on a Tuesday afternoon. What the data reveals next, the specific withdrawal sequencing errors that erode the advantage even for households that crossed all 4 thresholds, represents the operational layer that most retirement plans never reach. That analysis is mapped and available immediately. The question it raises about your current distribution architecture is one that the numbers in this video make urgent.